bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the Tuesday, July 23rd, 2024 podcast. I'm joined today by my partner, Susan Wilson, and Novogradac principal, Robert Bennett. And we're here to bring you another exciting installment in our So You Want to Be a LIHTC Developer series. This series is designed to help first-time and newer developers learn more about the low-income housing tax credit from the initial planning phases and development all the way through to operations and compliance. Our topic today has important implications for all low-income housing tax credit developers, both new and experienced. But it's also relevant to property owners, managers, investors, syndicators, underwriters, and many more involved in multifamily or public housing. Today, we're going to share some of the many ways low-income housing tax credit audit provide value to owners. In preparing for the podcast, Susan, Robert, and I narrowed our list to 6 key areas that can be especially important to LIHTC owners during the life of the property. That said, there were many additional benefits that didn't make it on our list. In due course, I'll have Susan and Robert back to continue the discussion. Now, many developers think of LIHTC audits. When they think of LIHTC audits, they often see them as an obligation, something required by their investors or lenders, basically a box they have to check. While many times, technically, investors, lenders, or regulators do require low-income tax credit owners to undergo an annual audit, there are many benefits to the owner of the property of the audits. As such, not all audits that we perform in Novogradac are solely to satisfy investor, lender, or regulatory need, but because the owners see the greater value. And for owners of LIHTC and other properties, annual audits do provide an opportunity to be more informed and strategic with decision-making. Audits also can provide enduring value to help sustain the feasibility of affordable housing properties over the long term. Now, for an audit to do so, one key is having an auditor with expertise in low-income housing tax credits, more specifically, in residential rental properties more generally. And to that end, I'm modeling my own advice here by inviting 2 of Novogradac's low-income housing tax credit audit experts to share their insights with you today. As I mentioned earlier, my colleagues Susan Wilson and Robert Bennett. There's a lot we're going to cover today. If you're ready, let's say every week, let's get started. Susan, welcome back to Tax Credit Tuesday.
Thanks,
Robert,
Mike.
welcome to your first guest appearance on the show.
All right.
Great to have you joining us. Now, to start off, please each of you introduce yourself briefly to our audience. And I guess in Susan's case, it's reintroduce yourself. And to Robert, it'll be introduce yourself. And talk about some of the services you provide in Novogradac, low-income housing tax credit, or other clients. Susan, go ahead and go first.
Thanks, Mike. And thanks for having me back. I really appreciate it. It's great to be back, and I'm honored. I represent the Austin office of Novogradac. I am one of 7 partners in that office. The services that I provide relate to audit and tax preparation for operating partnerships and LLCs that are operating within the low-income housing tax credit field environment. I also focus on HUD audits under requirements for anytime there's HUD assistance, whether it's rental assistance, insured mortgages, similar. I prepare and provide final cost certifications, HUD mortgager cost certifications, contractor cost certifications, and I provide consulting both in the LIHTC and the HUD areas.
All right. So you said Robert Bennett, and I'm out of the Southfield, Michigan office. And for those of you who don't know where that is, it's just a suburb of the beautiful and revitalized Detroit. And I do audits of financial statements. I'm more on the audit side, and I do anything in the multifamily housing arena, as well as HUD audits, public housing authority audits. I'll do some property compliance consulting, as well as LIHTC and HUD consulting.
Great, thank you both. Now let's dive into our topic of the day. Now, as I mentioned in the intro, preparing for the podcast, we agreed to focus on 6 out of many ways locally attached audits provide value to owner developers. Now, I thought it'd be useful to address each of those 6 in order in which they occur during the development and operational cycles of a locally attached development. And I figured the number 1 item on our list was the calculation of eligible basis. Calculation of eligible basis is obviously a big item in the low income tax credit world, as our regular listeners know, and anyone who has any experience, any notable experience in the local tax credit, eligible basis is the top line, the beginning, the foundation of determining the tax credits a building is eligible for. Obviously, there's also, if you're productivity bonds, and as a general matter, the larger the eligible basis, the more tax credits you'll claim in general, getting an allocated, often referred to as a 9% credit. Then if you get excess eligible basis, you may not be entitled to more tax credits, but it can help you in other calculations, which we'll talk about later in the podcast. But this is an area where the annual audit itself actually interrelates with the cost certification. Cost certification is a separate service, but it's integral to both the annual audit as well as the determination of long-term tax credits. And in some scenarios, developers might inadvertently be misclassifying certain costs that are otherwise includable in eligible basis. Susan, I thought it would be useful if you explain the interrelated roles of the annual audit with the cost certification in calculating eligible basis.
Sure. So a lot of the time we are engaged to perform audits during the construction period before a property places in service. Many times there will be lenders, equity providers will have requirements, syndicators will have requirements for audit. When we do these, we call them CIP, construction in progress audit. The assets tend to be presented to us in a balance sheet that has one line item, which is construction in progress. And it'd be pretty simple for us to audit that statement and say, to do the testing we need to and say, oh, that CIP line item, construction in progress, is materially correct. But when we are engaged for these audits, we sort of take the opportunity to think about our clients and think about how the costs are going to be allocated in the future, or how they're going to be classified in the future when we get down the line into the final cost or certifying the final cost and determining what the eligible basis is. For example, we like to look at that first construction draw and see what the components are there. Usually you'll see some closing costs, some legal fees. There'll be costs that could be identified as development costs or could be part of basis. There will be amortizable costs that are associated with the loan. We look at our soft costs during that period, your interest, your insurance, for example, any property taxes if applicable. And we just start taking a look early. I think having that audit during construction really gives us and our developers, our clients, the opportunity to look early at costs, to sort of parse them and strategize about which ones can be included in eligible basis, which ones can't. And we're able to look at kind of high level, maybe making sort of projections of where we think we're going to land when we get the property placed in service and start looking at what kind of the amount of credits that are going to be delivered.
Thank you for that. That's obviously really important in terms of the classification of the cost. And you also sort of highlight the fact that by doing that during the construction process phase, you sort of are doing some of the work that ultimately is needed as part of the annual audit and as part of the cost certification. And by doing that work in this earlier phase, in addition to getting a more accurate calculation, you're also shortening the additional work that will be needed later during the cost certification and the annual audit. And as many of our regular listeners know, oftentimes equity contributions from investors are dependent on receipt of a cost certification. And as a consequence, by doing that earlier work, the cost certification is done more quickly and that equity contribution can come in more quickly. And similarly, there could be equity contributions contingent on receiving 8609 and FILDA, which is the form the city agency gives you, entitling you to a certain amount of tax credits. Getting this work done earlier can make the cost cert completed earlier, which means you can get the 8609s earlier. In addition to accuracy, it's also useful from a timeliness perspective. Let's move on to number 2 on our list of 6. We just discussed eligible basis. The second on our list was tenant compliance. The law of LIHTC test for property owners are responsible for ensuring many areas, but 2 of the more principal areas of compliance are that the units themselves are rented to income eligible households. And then second, that the rents are restricted at a level below at or below the maximum amount allowed under Section 42 of the Internal Revenue Code, as well as at or below any other regulatory commitments a given property has made. Robert, please give an overview of some of the ways, some of the procedures that are performed during an LIHTC audit that can help identify potential issues related to tenant compliance.
Yeah. So during a LIHTC and even in our HUD audit, we'll obtain a sample of tenant files. It will focus on move-ins, and we're going to test those to determine that all the tenants are qualified and that they meet the rent and income limit and other compliance requirements, and really just making sure that these things are being adhered to. So if we find a compliance issue, we're going to work with the owners, determine that, hey, is this an isolated incident or is this something that is systemic and we need to dig a little deeper in or immediately address? So this isn't an all-encompassing list, but some of the things that we typically find are some things that we might run into if we run into anything is a miscalculation of household income, inadequately verifying tenant income and assets, and improperly calculating utility allowances. If having these issues could result in a financial loss through the reduction of current and future credits, but this can be avoided if the non-compliance corrected within a reasonable period from when it's been identified. So we can help our clients recognize or really document when they found this out and what steps they did to correct it so that they have the evidence ready if they need that in the future.
Yeah, thank you for that, Robert. I appreciate you particularly focusing on the correction period. One of the items that I always think of with respect to the annual audit is with respect to non-compliance to lovely tax credit, owners have a reasonable period of time to correct non-compliance. But as you noted, it's a reasonable period from when they discover it or should have discovered it. And by virtue of getting an annual audit, getting the annual tenant testing, that's a strong argument to the IRS that we shouldn't have discovered it earlier. And when we did discover it, we correct it within a reasonable period of time. But it's definitely a good argument to have in the event that the IRS were to challenge you on when you should have discovered it. I thought it would be also useful, Susan, if you could just share some examples where the results of the audit test on tenant compliance did lead to operational improvements or otherwise minimize future compliance risk.
Sure. Yeah, I think the important point here is that, while we are doing an audit on the financial statements and on whether they're materially correct, whether the disclosures are materially correct, we do some compliance testing as part of our LIHTC audits to just help our clients ensure that they might not be missing something. A lot of times, or not a lot of times, sometimes we will identify some discrepancies between information on rent rolls and what's in the underlying lease agreements with the tenants. Just because there's a discrepancy there doesn't indicate that there's non-compliance. So it doesn't have an impact on the outcome of the audit. But it is something that opens up some conversation between us and our clients. We can present those discrepancies to the client. We can help them resolve issues. And sort of to Robert's earlier point, we can help them identify whether there are some internal controls that need to be established or refined that will avoid those kind of discrepancies in the future, kind of just keep things clean. And another, a really good example, I think, of something that we had a few years ago with one of our clients was during our test of tenant compliance, we identified, and also our test of revenue, we identified that they had vacancies in units that were out of service, which, as Mike, you mentioned earlier in the podcast, out of service units need to be identified when they should be identified and need to be corrected as soon as possible. And owners need to be making efforts to avoid any type of tax credit reduction or recapture. And so in this case, we identified vacancies, we opened up the dialogue with our client, we determined the cause of the vacancies, we helped them strategize on how they could effectively mitigate any recapture. We got into a lot with them, with helping them with calculations, corresponding with the limited partner. There was really, I feel like we really were able to provide a huge value outside of just the typical audit in that case.
Yeah, thank you for that, Susan, because it also, brought awareness, because, obviously the project manager knew the units were out of service.
Mm.
There wasn't the awareness as to the consequences
Exactly.
of that fact. And, the annual audit was able to bring to the attention to the right parties. Obviously within the organization, the knowledge was there. It was just a question of, did one side appreciate the significance that the other side did appreciate? And Robert, when we were preparing for the podcast, you had a number of examples as well. So please share some of your examples.
All right. So one of the most common examples that I run into is concerning security deposit testing. And so for HUD assisted properties, it can be a little bit stringent in that the security deposit account has to be segregated from operations or any other account, and that deposits into that account have to be made timely, and that the security deposit has to exceed the liability. When that doesn't happen, it can create some issues. We may have to have a HUD finding, which is going to create a little more expense. It's going to take a little bit more time to answer those, or it's also going to be in a management letter comment. And so we have in the past made suggestions to be able to have our clients increase the effectiveness of their internal controls over that issue.
Right. And that just,
think-
go ahead, Susan.
Sorry, I just wanted to add to that. I think, Robert, part of it is the timing of the audit. We do the preliminary and interim procedures ahead of the year end. And I think you'll agree with me that a lot of times these type of compliance issues, we're able to identify them early or caution our clients early so that they can be resolved before we get to the balance sheet date and the year end audit. And then a finding is avoided altogether.
Thank you for that, Susan. And that's we had our 6 ways we're talking about today. That is definitely, you tucked in that one. All the more reason to have a follow-up podcast for some of the other ways, some of those, in addition, maybe best practices for working with your LIHTC auditor / HUD auditor. But let's move on to number 3 on our list. So we've talked about eligible basis. Talk about tenant compliance. Tenant compliance is integral to determining your long-term housing occupancy percentage, to determine what your qualified basis is, to determine what your tax credits are. And as our regular listeners know, the long-term housing tax credit is earned over a 15-year period. Earned as in, at the end of the year 15, the investor is no longer at risk of recapture for activities in year 16 or later. However, the credits themselves are claimed generally over a 10-year period. However, in the first year, you only get the claim credits for the portion of the year the units are actually rented, long-term families at restricted rents, and any amount not claimed in year 1 can be claimed in year 11. And as a consequence, the first year, it's rare for a property to get a full year of their tax credit allocation claimed in year 1. Because you're leasing up the property in that first year, and you get credits based upon an average of your occupancy during the course of the year. Now, there are several factors that can influence how much tax credits are generated in that first year. And Susan, I thought it'd be useful for you to describe how the audit and tax work that we do can help identify some of the ways to increase first year credits.
Right. And I'm really tempted here to go down into the weeds. So I'm going to try to stay high level. I think we could do another entire episode on this. But yeah, as we all know in this industry, the equity stream comes in and there are equity installments that are paid. And those installments are paid across the different times of, the development phases. One of the installments comes in when we do start delivering credits. And the amount of that installment is typically determined by the amount of credits that are delivered as compared to the original projection that were made. And I think, Mike, you've always made a point that the one thing that can be said about projections is they're almost never, reality is almost never what the projection says. So we do our best when we're modeling, and the general partner, limited partner, identify what they think that first year tax credits are going to be. They aren't usually exactly that amount. And when they're not that amount, there can be an adjuster. There's a provision in the partnership agreement to adjust the amount of the equity depending on the timing of the delivery of the credits. So the more credits we can deliver in year one, the better. To the point that you made a few minutes ago, that first year credit is highly dependent on how quickly units are placed in service. There's a detailed calculation that's made based on the average units in service that year. A lot of times, though, when we're performing our audit and we're determining eligible basis, kind of going back to number one or number two, I think, from this episode, we look at how much, we look at how costs are categorized or classified to maximize basis within what the law will allow or regulations will allow. A lot of times, and recently this happens a lot with cost overruns that we have and other factors and, economic factors, we're ending up with more basis than is needed to deliver the amount of credits. And when we have that situation where we have excess basis or a large amount of cushion, we can calculate credits in that first year using that excess basis applied to the eligible basis calculation and the credit amount and the applicable fraction of, the average of the unit occupancy. And applying that excess basis delivers more credits, I guess, without going too deep.
You're doing great.
Yeah. So we're able to do that. We're able to identify that during the audit. So I feel like that's a huge place where we're providing value that's far beyond just an opinion on the financial statement.
No, thank you for that, Sue. And as you put it out, there could be a whole podcast on the first year calculation of a new construction property, much less an rehab. Boy, fairly complex matter, and not technically complex if you have experience, but if you don't have experience, then obviously anything's complex if you don't have experience. And as you summarized pretty effectively, that the bottom line is if you have, quote, excess eligible basis, more eligible basis than you need in order to be eligible for your annual tax credit allocation, that excess basis can create value in the first year of your credit period in order to generate more first year credits. And as a consequence, avoid equity adjusters, downward equity adjusters. And I would note for developers out there, the whole concept of the equity adjuster is that, if you're predicting 500,000 of tax credits in year one and you only deliver 250,000, from the investor's perspective, they're getting 250,000 less credits in year one, and instead they're going to get 250,000 more credits in year 11 than originally planned. And if, as a developer, would you rather have $250,000 today or 250,000 in year 11? Or said differently, how much will you pay for 250,000 today versus 250,000 in year 11? And obviously, you're not going to pay the same amount for that. So that's the whole concept of equity adjusters. And it's also something, Susan, when you were mentioning during the construction in process or in progress, that's, at a time also to be thinking about place and service dates and equity adjusters and all the rest. Once again, for our next podcast. Robert, I'm just going to go ahead and jump past this and go on to cash waterfalls and distributions, which was number 4 on our list, because we've dealt with eligible basis, we've dealt with tenant compliance, first year credit period. Now we're getting to the operational phase, and properties can start generating some amounts of cash flow. Partnership and operating agreements have provisions for how you calculate operating cash flow. First, you have to calculate what is operating cash flow. And then secondly, there's what's commonly referred to or colloquially referred to as a waterfall. or basically the order in which the distributions of the cash flow need to be used. And further, some HUD-assisted properties distributions are subject to a different calculation of distributable cash that is less based on cash flow and more based on cash in the bank at a certain time. So with that as a general background for our listeners, if you could, Robert, maybe share some of how our audit procedures help owners adhere to the underlying agreements when they are making cash distributions of operating income.
Okay, great. Yeah. So I'd like to start off by saying that many times we'll read the provisions of a partnership agreement, the development agreements, other documents, and we'll say, wow, I wish you would have talked to us, before you signed this. Because a lot of times these are negotiable. And things that are negotiable that's specific to the developer is a cash waterfall distribution. Could be guarantees, deficit obligations, equity adjuster calculations. And sometimes because of the volume and just the amount of partnership agreements that we look at, we might be able to have some suggestions for you. I'm not saying that it's necessarily going to happen, but it gives you some information in which to conduct your negotiations. And then sometimes we can provide insights on some development issues that might be state specific. And we can help maximize the credits and the equity. And the same with HUD financing, we might be able to maximize the mortgageable basis. But once all of this is in effect, it is really hard to make changes after the fact. So on to how we approach this, we're going to take a look at the distributions section of your partnership agreement, and then we're going to do a calculation. We're going to take our calculation based on what we see there, and we're going to compare it to what our client has provided. Now, we hope that these two things will mesh and they'll be the same, but sometimes they're not. And so when they're not, we're going to investigate, find out, hey, why is this different? And we'll make sure that we come to the same conclusion. Some of our clients ask us to do the calculation and include it as supplementary information within our audit. So that helps give, legitimacy, to the calculation. So when they go to present it to their investors, they have something there to rely on. And so in the case of HUD-assisted properties, that require a surplus cash calculation, we're going to take a look at the regulatory agreement. And then we're going to determine, which version is applicable to the owner. This is knowing there's 3 different versions, and knowing which one that you have is very important. Example, I had a client and they thought that they had a finding due to an over distribution. Long story short, they were including a deduction from available cash that was not applicable to them. So we were able to do a recalculation for them, and they were able to submit that to HUD and kind of get that finding taken care of. And actually, just a couple of weeks ago, I had a conversation with one of our clients who wanted they got a letter from HUD saying, hey, we think we found a finding here. They asked us to speak to HUD on their behalf. So we speak the same language as HUD. We know the regulations. Of course, we know our financial statements. So we were able to talk to HUD, explain, hey, here's where you find this or whatever that situation was. And at the end of the conversation, the HUD field agent that we were speaking with was fine with what we had found, and they were able to rescind that finding and close that. That saves the client a significant amount of money, because when you have an over distribution issue, HUD may make you pay that back. So now that's going to take cash flow. And in addition, they may have some fines and penalties. Sometimes they will do that. We want to make sure that we have that set and correctly stated, and we're there to help to make sure that HUD understands exactly what is transpired.
Excellent. Thank you for that. I know we could talk about that for a lot longer.
Absolutely.
I want to move on to our last 2 items on our list. The 5th one on the list, what in terms of ways that LIHTC audits can add value, is through what we commonly know within the accounting profession as analytical review procedures. And for a layperson, that's when auditors compare various metrics of an individual property to an average of a larger group of properties. So, Susan, I thought it would be helpful here if you could share some examples as to how these analytical review procedures have identified issues or opportunities for clients.
Of course. I'll back up a little bit and mention
Please.
that we perform these procedures at all phases of the audit. They're performed at planning, they're performed during the audit as substantive audit procedures, and then at the conclusion of the audit. So it's sort of an ongoing and iterative process, and information that is gained from the preliminary analytical review procedures will sort of feed into what happens with the rest of the audit. I think the most important thing to our clients, though, is that we're not just in the back room performing these procedures. As we perform them, there are oftentimes things that we identify that open up opportunities to have a dialogue with the client about where there are opportunities or there are obstacles that we can talk to the client about. What are the strategies to overcome these obstacles? A lot of it relates to risk assessment for our audit, but we keep in mind that audit risk often reflects our client's business risk. So what's important to us is also important to you as a client. And always with these analytical review procedures, we start with an expectation. If we don't know what our expectation is, then we don't know if the results are falling outside of that expectation. And as you mentioned, Mike, a lot of our expectations are derived from what we see in the industry, what seems to be standard for certain expenses or for certain ratios. I think some more common examples of where we identify things and work with our clients are areas like right now, the hot topic, insurance expense. That's a really hot topic in our industry. It's probably a hot topic just kind of globally, regardless of being in multifamily housing, but we're seeing it a lot. We're seeing cancellations. We're seeing insurance companies just completely exit the business. We're seeing really high insurance expense. So when we identify that in our analytics, we go start talking to our client about, what's going on here? What's the cause of this change in insurance expense? Is there anything we can do based on our knowledge, experience, our contacts that we have, network, that we can help you with that? Similarly, when we see evidence of a casualty event or insurance proceeds, we look at in our analytical interest rates on debt. Because we have so many clients that we serve, we kind of know what the trends are right now, and we can help identify if there might be opportunities, for example, to refinance to save money. We put a lot of emphasis on related party activity. We know that's a lot of risk to you as a client. That's a lot of risk at the audit level. And then also cash flow, which we just spoke about, but going concern and cash flow, those are areas where we perform analytics and we can actually open up some dialogue with our clients and help you identify opportunities, strategize, just to continue to generate as much cash flow as possible, because it benefits all the partners or all the members of an LLC.
Great. Thank you for that, Susan. And I would just sort of add also, as we've discussed, given all the LIHTC work that we do at Novogradac, we're definitely constantly seeking ways to improve and be more specific and more nuanced, more granular in our analytical review procedures for individual audits. So I'll just say for listeners that are clients, stay tuned. More to come in terms of how Novogradac will be enhancing that in the future. Now, the sixth item on our list today it is the final of our six, but as we mentioned before, during the course of this podcast, we'll get Robert and Susan back to continue the discussion in other areas. But the sixth is, in some ways, I'm probably biased, but I think we save the best for last. And that's the value of tapping into your auditor's industry experience. Robert, could you share some of the ways in which your industry experience has helped your clients mitigate risks, identify opportunities, essentially just save them time and money?
Right, sure. So part of our procedures is gaining an understanding of the client's internal controls. And so through performing those procedures, we get to learn about you, the client, your risk profile, your business practices, things that you're comfortable with, just overall kind of what makes you tick. So we do this over several clients, and that allows us to build some best practices. right? And so we'll share that with our clients. And an example I have is I have a client who has a very small accounting department, and they wanted to make sure that they had proper segregation of duties. And it's because of our understanding of the client and our experience, we didn't need to go and, dig up some more information. We already kind of had it. And that's kind of an advantage of using your auditor over maybe going out and getting a consultant from somewhere, because they're going to have to come in and do exactly the thing that we've already done in the course of our audit. So we were able to come up with some solutions to achieve their goals and increase the effectiveness of their internal controls, even though they had kind of few resources. Another example that I'd like to share is I had a client call me in a little bit of a panic because they needed to get a report on the green MIP program. And there was a compliance reporting that they had to get done, and they were coming up against a deadline. But this is performed by a very specific type of engineering consultant. Well, it just so happened a few weeks prior to me getting this call, I had spoke with an engineer consulting firm with another client about the green and resilient retrofit program. And I was able to connect these two people together, and that client was able to get that completed. Now, with that MIP program, I'm sorry, it's the mortgage insurance premium, and it provides for a 25 basis points reduction if they meet Energy Star requirements. Well, you can imagine 25 basis points is a lot of money.
Not on a large roof.
For sure. That is sure. So client was very happy that we were able to make that referral and get that done for them.
Great. Thank you, Robert. And Susan, I know you could add a bunch of examples as well. I know Robert had more when we were preparing for the podcast, but I'm going to try to bring the episode towards the close. But before I do that, I did want to just give each of you an opportunity to share any concluding tips that you can share. And Robert, I'll be happy to let you continue, and you can go first in terms of any concluding tips before we get back together for our next podcast.
Sure. The first thing I want to say is I think some of our clients really should tap into our website and look at some of the things that we give for absolutely free. There is you can go into the search bar into our website, and if there's a topic that you type it in, and there will be articles, there could be upcoming webinars, whatever that might be, you'll find some of that information. The rent and income calculators. I know you've had just podcasts just on those topics alone,
Yes.
but it's a great thing for our clients to be able to take advantage of. And then I also want to say, kind of related to my point just about that client who called me, we have, just because of all the contacts that we make throughout the industry, we have a lot of people who we can refer if a client needs. And I mean, again, these are absolutely free. We know attorneys that, practice in particular areas. We know lenders. Actually, just before us doing this call, I had a call with a lender who has a client that wanted to look into the Inflation Reduction Act and the 45L tax credits. So we went and we spoke about that. And now if anybody were to ask me, hey, do you have a lender that has some experience in this area? Hey, we might be able to refer. So if you have an opportunity to attend our conferences, I highly would recommend it. And if there's somebody who's going to be at that conference who you want to meet, who you don't know, I think any one of our Novogradac staff would be happy to make that introduction if they know that person. Or I guarantee there's somebody who knows that person within our firm, and we'll make sure we make that connection for you.
Right. Thanks for all of those. And I would just emphasize, your point about, if you're looking for an attorney and things of that nature, or an investor and all the rest, because I get those questions all the time. And we have, lots of relationships, and my own approach is to say, well, here's 3 attorneys, or here's 3 syndicators, or here's 3 lenders, and all the rest. And to give you kind of give the clients or prospective clients a starting point and then they can, interview the various ones to see who kind of fits it the most. And, it really allows them to start with some experience, with someone who they know has experience in these areas. Susan, please share your concluding tips.
Well, I think it's kind of evidence from everything we've talked about so far today, but I feel like the biggest overarching concept here is that there are very few independent third parties that you as a client work with who have as much access to your financial information and your operations as auditors and tax preparers do. So I think it's great to sort of develop that relationship so that we can always work together and provide guidance and strategies to help improve your business. We learn your business, we know your business as part of just the engagements that we provide, the services we provide. We know what's happening in the industry. We can share industry insights with you. And then we do have to remain independent for most of our test services, but while remaining independent, we're still able to provide suggestions, recommendations, and we can really help, keep your business going, moving on to the next level.
And I would just emphasize independence and confidentiality to it. So we serve a very unique role as we provide audit services. So Susan and Robert, thank you. I will include your contact information in this week's show notes. I encourage our listeners to reach out to either Robert or Susan with any follow-up questions that you have. I'd also like to encourage the listeners to send emails to CPAs@novoco.com, NOVOCO.com, with any questions you think we should include when we get Susan and Robert back for a future episode. And before we go to the off mic section, I'll also say, I say it every week, but please, if you're enjoying the podcast, please do subscribe to the podcast, subscribe in your preferred platform, or just keep going to the Novoco.com website to download it. And also, please do share the podcast with your colleagues or anyone else who you think you'd find it useful to. And if you're really enjoying the podcast, please take a second to rate the podcast on your various platforms. We get ratings of the podcast. It helps identify the podcast for other users. Now let's turn to the off mic section. And this is the part of the podcast that's become quite a highlight where guests get to share a shout out to a colleague in the community development, affordable housing, historic preservation community. That's a great way to recognize others that do such great work that we're so proud to do at Novogradac. Susan, since you're the old pro on the podcast, I'd let you go first and give Robert a bit of a break.
Of course, happy to. So my shout out is to Denise Murphy Edwards. She's with Murphy Consulting. It's her own firm out of the DC area. I work a lot with Denise with mutual clients. We both serve the same client base, but we provide different services. What Denise will do is she helps her clients with registering with HUD, and they have a system called APS, so it's Active Partners Performance System. It's just an area where HUD identifies who the partners are within an organization and approves them for doing business with HUD. And every entity that works with HUD has to register in that system. It's not a service that Novogradac provides. So Denise does provide that service. And sometimes there are errors within that system. Sometimes there are finding flags that come through audits or inspections. And Denise and her group can help our clients resolve those issues, just like we do. And like Robert mentioned earlier, Denise speaks HUD's language. We speak HUD's language. So a lot of times she knows the people at HUD, and she can, work with us or work directly with the client to moderate discussions between the client and HUD to quickly, efficiently resolve any issues that are out there. So they provide a lot of good consulting services to people in the HUD industry and developers, owners of properties that are assisted by HUD. And I think it's great work that she does, and I really enjoy working with her. We panel together on a lot of speaker panels at different industry events, and she's just a great person to work with. And people, she really helps her client.
Great. Thank you for that shout out. I'll echo the shout out to Denise Murphy Edwards of Murphy Consulting as well. Robert, your turn to share an industry shout out.
Yeah, I would like to shout out Jason Race and Lisa White over at Bedrock Housing Consultants. I actually met them at a conference, and subsequently to that, we had some mutual clients, and so I had the opportunity to work with them. Now they work more in the public housing authority and the nonprofit area, but they help some of those who might have gotten in a little bit of trouble or they need some extra assistance in either preparation of their trial balances and those kind of things. And then some of them, they just add extra assistance for some of these organizations. It's been great working with them. And, I know I'm only supposed to have one shout out. Can I press my luck and get two?
Well, I have you already had two, so I'll call that the Bedrock Housing Consultant. Jason and Lisa. I'll give me echo that shout out, but please share another one.
I'm a regular speaker at our LIHTC Basics courses at our affordable housing conferences. So I wanted to give a shout out to all the participants that were at one of my training sessions. It was a joy to have you. I always like doing those courses. So shout out to them.
Great. Thank you. Thank you for those shout outs, Susan and Robert. Thank you both very much. And to our audience, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novaco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novaco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.